Good afternoon, everybody, and welcome to the All About Dividend Investing webinar. My name is Derek Law, and I will be your moderator for this webinar. Today's webinar will be presented by Peter Hodson, who is the CEO and Head of Research at 5i Research. Before we get into our presentation, I want to make sure you can hear me okay. You can reply and ask questions in the chat window, which you should see on the side of your screen. Okay, so I'm hearing from a few people that they can hear fine. Okay. Okay, great. So without further ado, I'm going to pass the mic to Peter.
All right. Thank you, Derek, and thanks for bearing with us. We had a couple of audio issues, but I think everything's working fine. So I'm just going to start going. And Derek, if there are any issues on your side, just send me an email and we'll pause. But we'll just keep going. We've got a lot of information to cover. So thanks for joining us today. Hopefully everybody enjoyed the market rally today. It's been a crazy year so far, but never a dull moment in the stock market. So we'll get right in it and we'll try and tell you all about dividends and what to look for in dividend stocks and how to set up a dividend portfolio and how to avoid losing money, which is, of course, one of the most important things in investing. So there's a big disclosure from Questrade. I guess one comment, my companies have no compliance departments because we don't manage money and we don't trade stocks and we don't look after companies or anything like that. So some of our rules in terms of compliance are a little bit different. So I may refer to a couple of charts that actually aren't on this presentation for compliance reasons, but trust me, the charts do exist and we can get you copies of those if you really want one. So we're going to give you an outline here. We're going to introduce sort of the thesis on dividend stocks, what you might want to do after a very, very strong market period. A lot of people may have looked at the past month or 3 months in oil certainly and said, what kind of a bull market is that? But it's been a very strong 5 years post-2008 financial crisis. We're going to take a look at sort of how to screen for dividend stocks, what to look for a good company and what to look for in a bad company in terms of dividends, because there's lots of red flags that you need to watch out for with dividend stocks. And if you just search for yield and you're just trying to get yield, you often end up losing far more on your capital than you do than you get in your dividends. So it's very important to watch out for the problem companies before they become problem companies. We'll talk a little bit about the financial industry. We'd like to beat up mutual funds and their fees, of course, and how to set up your own dividend mutual fund will be kind of the wrap up at the end of the presentation. And we will have time for questions at the end as well. So just a little bit of a commercial for us. We have two companies, 5i Research and Canadian Money Saver. 5i Research is a company I started 3 years ago just because I wasn't really happy with the way the industry was treating investors, quite frankly. I was a mutual fund manager for a very long time, and I saw the excess fees people were charging, the index hugging that managers were doing, and the big giant bonuses that investment bankers were getting. And it just really was detrimental to the investor. So I just decided to kind of come up with a new model and say, I'm going to offer some research. I'm going to answer investor questions, and we're going to have model portfolios, none of which will have any conflicts. So we don't trade stocks, we don't manage money, we don't have deals with companies, we don't promote stocks. So if we think the company is lousy, we tell you, and it really doesn't impact us. If we think a company is worth buying, we can tell you that as well. And if you buy it, we really don't care. It's got nothing to do with us. We don't make any money off of it that way. So we've actually answered 28,000 investment questions so far, and we have 70 research reports and 3 model portfolios as well. One's coming up later this year, 2 right now. They've done fairly well right now, but that's the end of the commercial. And then we have Canadian Money Saver magazine. That's a magazine that I bought 3 years ago. It's been around since 1981, offering independent financial advice. Covers the whole basis in terms of financial planning, yada, 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 that sort of thing, and what to look for in terms of setting up portfolios as well. So right down, that's the end of the commercial, right back into the beat of it. Basically, what to do after a very good market. We've had rising markets for a long time. They've been propped up by stimulus. They've been propped up by falling interest rates. And lo and behold, 2 weeks ago, we got another interest rate cut in Canada. So that party continues in terms of stimulating the economy. A lot of people have mixed views on what the governments did post-2008. But if you look at where we were, where the financial market was very close to ending, I don't know if people know this, but the United Kingdom financial system was within hours of closing one day in 2008. If they couldn't solve a banking problem, their solution was just to close the banks completely until they could come up with a buyer for some problem assets. So we went to the brink, and the Fed basically took us away from the brink with massive quantitative easing. And of course, everyone was concerned about what would happen to the market when quantitative easing ended. There was a year and a half of worry about what was going to happen. And if you look back to last year, guess what? Quantitative easing, at least in the States, is completely over, and the market is doing okay. Thank you very much. And I think a lot's going to happen with the fear of interest rates as well. You've got a situation where everyone mostly knows that interest rates are going to go up in the U.S. later this year. But if you recall, that's what they thought last year as well. So I don't really want to forecast interest rates, but the market's had, I think, 7 years now of worrying about higher interest rates. So I think it's going to be priced in. And really, it all gets back to what are company fundamentals. You've got a situation right now where lots of companies are reporting earnings right now, but so far, according to S&P, more than 70% of companies are beating earnings expectations. So it's really not a doom and gloom scenario. And we get lots of questions at 5i about, one of our customers was listening to Peter Schiff or some other doom and gloom person, and there's always something to worry about, of course. That's why you get a equity premium. That's why you get paid more to own equities, and that's why dividends are attractive, because there's always something to worry about. If you don't want anything to worry about, you can buy a GIC and make your 1% a year, 1.1% or whatever they're paying right now. I couldn't even tell you what they're paying, but guarantees come with a price, and that price is lower returns on your investment. So if you are willing to take some risk, then equities are starting to look pretty good. Again, not a short-term scenario at all. You want to buy these for the long term. So right now, earnings are good. Interest rates are good. The economic outlook is actually very good in the U.S. The U.S. grew at 5% in the last quarter, perhaps a little slower right now, but in terms of the rest of the world, the U.S. market is looking, the U.S. economy, the market is very different than the economy, of course, but the U.S. economy is looking quite good in terms of actual fundamentals. In Canada, from an economic point of view, we do have the oil impact, but of course, with a rate cut and the U.S. economy dragging us along and the lower dollar offering dramatic improvements for exporters, I don't think it'll be that bad in Canada either. So a little bit of forecasting, but not a whole lot, because it all comes down to interest rates and earnings, and both are in a relatively positive environment right now. So as far as dividend goes, if you think the market is set for a collapse or a slowdown, dividend stocks offer you some protection. I'll talk to a few reasons why in a couple of slides, but dividend stocks that continue to pay you income, no matter what the market does, can be very attractive. Even from a cash flow point of view, if you're looking at buying stocks later when the market is down, you have some income from these dividend stocks that will provide you with capital to buy stocks at a discount. So it's not a bad scenario. The other thing that's good about interest or dividend companies is they offer one of the best ways to protect yourself from a rising interest rate environment. Companies can totally handle rising interest rates. That's generally the case when the rising interest rates are going hand in hand with a rising economy. Typically in a regular economic scenario, governments raise rates to cool down the economy. So if they're cooling down the economy, basically that means things are pretty good. And a company that is earning money, that has earnings power, that has pricing power, that's making cash flow, has the ability to raise their dividend in an environment of higher interest rates. So you've got a scenario where dividend stocks can actually help you in a down market, and they can help you when interest rates go up, if you choose the right types of companies that are growing their dividends. So as far as we're concerned, that's a pretty good scenario where things go badly, you're okay, and if things go good in an economic way, you're okay as well. So there's no such thing as a perfect stock, but dividend growing companies become one of the closest things you can get to sort of a perfect scenario. So I'm just going to transition a little bit and just tell you a little story. My wife's a high school teacher, and she asked me to teach an investment class for her one day, kind of a get out of work free kind of scenario. So I went in and I had to teach a bunch of 14-year-olds all about the stock market, and I had about an hour and a half to do this. And of course, I don't know much about teenagers. I've only got one right now, 3 more on the way, but I do know that teenagers are lazy. So I tried to get them interested in the stock market by describing a scenario to them where they could do a little bit of work and get paid forever. They could do a little bit of research and then they could own something that pays them money every 3 months for the rest of their life. And not only that, payment that they're getting while they're playing Xbox or Wii or sitting at home sleeping, that payment can actually increase with those companies that are paying dividends, that increase their dividends on an annual basis. So now you've got a scenario where maybe I've got these high school students interested in dividends. It's one of the scenarios where you don't have to do anything, you can get paid forever, and lo and behold, you can get a raise for doing nothing. And so that's sort of how I hooked them into starting to pay attention to some of the stock market theses that I had to tell them in the next hour and a half. But if you think about it, what other scenario can you get a raise perhaps every year and never do anything again? If you're lazy, you got to kind of like that scenario. So what do you need to consider? Well, one of the things that we've discovered over the past 30 years is the announcement of a company's very first dividend is perhaps one of the single best indicators of future investment success. And I'm not talking about a company like Apple a few years ago where there was some hedge fund pressure to force Apple to give out some of its cash to shareholders in the form of dividends. I'm talking about smaller companies that have done well, that have survived a recession or two, where management owns some stock and they have enough cash flow and they have enough confidence. And that's the absolute key. They have enough confidence to start paying a dividend. So they've never paid a dividend before, and the board of directors says, okay, it's time to pay back our shareholders. All those investors that stuck with us in the early days, stuck with us through the recession, stuck with us when we lost money, it's time to reward them. So the very, very first dividend from a company is very, very powerful in terms of finding new investment ideas. And I'm going to talk about that repeatedly throughout this seminar because it's pretty much the most important point I'm going to make. So when a company starts out a dividend, though, you have to make sure it's not too high. What you want is a company that can grow its dividend. You want it to start small and then grow, and you get sort of the double whammy. When a dividend grows, the stock price tends to go up, and of course your income automatically goes up as well with the dividend growth. So you want to have a scenario. Dividend growth is actually far more important than dividend yield. Dividend growth stocks do far better than high dividend yields, and that's one of the charts that I don't have here today, but it is mathematically proven that over time, it's the growth rate of dividends that really gets you the best investment return. So you want to have a company that has the ability to grow. You want to have a company that can survive a recession or two, and you have to have a company that has a bit of a cushion when things are not going that well. So you need to consider the payout ratio, debt to equity ratio, interest coverage ratio, and revenue and earnings growth is also very, very important. We're of the view at 5i that if you can't grow your revenue as a company, then you're hardly going to be a very attractive investment for us, for our customers. So it's a situation where if you cannot continue to grow your revenue at least in line with inflation, 1 or 2%, then something's wrong. Either you've got a weak product, weak salespeople, you've got a new competitor, you've got customers who are backing off, you've got an obsolete product. So at the very, very minimum, you want companies that can grow their revenue primarily. More importantly, if they can grow their earnings, that's great as well. But you've got to look to the top line to see really what the basics are and how that company is doing. You have to look at payout ratios as well. So for those that don't know, of course, the dividend payout ratio is how much you're paying in dividends versus how much you're collecting in cash flow. So these range all the way from 5 or 6% all the way to 145, 200%, which of course above 100 means you're paying out more than you're actually getting in cash flow, and that can't be sustained for a very long time. So, but there's very different ways of calculating payout ratios. Some companies use all-in payout ratios, and oil and gas companies use sustaining payout ratios, basically how much they need to spend on a continuing basis to keep their cash flow coming in. Some companies will use drip ratios where those dividends that they don't actually pay out in cash are excluded from a payout ratio. So these are things that you have to watch for. I'll talk about those in a little bit. Some disclosure stuff. Just on first dividends. Here's a few examples for a few companies over the past couple of years that have started to pay their first dividend. So ComDev, they announced their first dividend in last about a year ago with a 3% yield. We're not going to talk about specific companies in terms of their outlook, but these are companies that you might want to take a look at because they decided to pay a dividend for the very first time. Pure Technologies, interesting little company with a 1.7% yield that decided to pay their first dividend ever last year as well. AXIA Net Media, again, about a year ago, they decided to pay a dividend. Western Energy Services, a few years ago, of course, and of course their timing may not have been perfect with the collapse in energy prices and service stocks, but their first dividend was 2.5 years ago. And again, these are examples that merit further research. We're not going to say go buy them or anything like that, but certainly there's perhaps more research needed because they've waved a flag to investors to tell you something's going on and it's time to start paying money to shareholders. So you may want to check those out to see whether they can grow that dividend and what kind of company it might be over the next 10 years. A couple of examples in terms of growth. Water Furnace Industries is a company that is no longer in existence. It got taken out last year, but their very, very first dividend was 7 cents a share in 2004. When it was taken out, the dividend had grown to 25 cents per share. The stock price in that time went from $7.50 to $30 and change. So it's a situation, again, it's just an example, but I wanted to highlight the fact that when a dividend increases, the stock price almost always follows. So again, you get that double whammy impact from the capital gains on the dividend and the increased income, the capital gains on the stock and the increased income from the dividend. And this is why investors tend to favor dividend growth companies. Constellation Software, it's a stock we talk about quite a lot, and here's why. So their first dividend in 2007, 15 cents a share. Their recent dividend is $1 a share. And whenever I do this slide, it kills me because I always have to update the slide. So stock price in that period of time only has gone from $25 to, my slide says $290, which was created not that long ago, and the stock today is $356. So dividend growth follows capital appreciation. You get that double whammy. And I should mention, in terms of Constellation, one of the things they've done right over the past 10 years is they haven't issued any more new stock while they've grown their earnings as well. So that's not so much a dividend point to note, but for a good company, we like to make sure companies are not issuing stock left, right, and center and diluting their shareholders. So if you can get a company that maintains its stock float and doesn't issue shares, then you might be onto something, especially if it can grow with its internal cash flow. You get to own more of the company's earnings as you go along because they're not sharing those shares with anybody else and they're not diluting your ownership. So this is a pretty important chart, so I'll spend a little time on this. Sorry, not a chart, but bullet points. 5 reasons why investors consider dividends and why dividend stocks tend to do fairly well. So the first point, if you have 2 stocks, one is XYZ that pays you 0, and one is ADC that pays you 5%, and you're worried about the market, which stock do you think you're going to sell first? Almost every single investor we've ever talked to has always told us that they will sell the company that does not pay them a dividend first. So that stability of that income stream makes you think twice about selling a stock. So it may not be the best company in the world, but it certainly slows you down from selling it if they continue to pay you. The other thing about dividend stocks is they do tend to be more stable, partly related to the first point. People do not necessarily sell them willy-nilly just when they start to be worried. There's no, if you don't pay a dividend and an investor sells your stock, there's really no loss to them. They're not losing any income. They can buy it back at any time. They don't miss out on a dividend payment. But if you have a dividend that your stock is paying, then it just becomes more stable by default because investors are always looking for that dividend, and there's always a core group of investors that will buy it from you to get that dividend as well. There's lots of dividend funds and pension plans that will do dividend capture trades where they're just more interested in dividend stocks. And in fact, there are numerous investment companies, pension funds, and so on that cannot even buy stocks that don't pay dividends. So you've got this natural group of buyers that is only buying dividend-paying stocks. And again, this makes them more inherently stable than some of the crazy stuff that's out there. The third point is one I really, really like, is if you're a company management and you have to come up with a dividend every 3 months, it just makes you think twice about going off on a crazy acquisition or adding debt or making a deal or paying your employees too much. Because if you can't come up with that cash to pay the dividends, then your stock's going to go down. You may need money. You may get fired. There's lots of things that can go horribly wrong if you don't pay the dividend. The dividend, of course, is not mandatory, but as far as the stock price goes, it is pretty mandatory. When a dividend gets cut, it can be pretty ugly in terms of the stock market. So management likes to look at these dividends, and the last thing they want to do is cut them. So it just instills a little bit more management discipline, knowing that every 3 months or every month, if it's a monthly paying dividend, these management teams have to come up with the cash to pay their shareholders. So that forced discipline is really quite attractive in terms of making sure management doesn't do the wrong thing. The fourth reason, typically dividend paying companies get better valuations in the market. For all sorts of reasons, we've discussed a few already. But again, they're just highly valued. There's a certain group of investors that like to buy them. Investors will pay more for an income stream than they will pay for no income stream, and they just tend to get higher valuations. And then finally, and this is where I can't show you a chart, but on our Canadian Money website, Canadian Money Saver website, we do have a chart that will show you this. Dividend paying stocks have a dramatic outperformance over both the TSX and non-dividend paying stocks. It's really quite a dramatic outperformance. I think it's 5 or 6% over the long term on an annual basis, reflecting all of the above qualities and reflecting the fact that when a dividend is growing, the stock tends to do particularly well. And so those two things sort of combine to get you quite good investment performance over the long term. So some things that you might want to consider when you're looking at investing in dividend stocks. And one thing that is perhaps, there's no easy money in the stock market. Of course, it's always very difficult. But one of the things that we like to watch out for is a dividend increase, which is the company telling you that they're doing well. So they've bumped up their dividend. Business is good, cash flow is good, and more importantly, management is confident. And then the whole market goes into the tank for a period of time. So often what happens is when there's a whole market problem, of course, all stocks tend to go down, and you've got a company that has just told you that things are going very well. Just maybe a week ago, they told you things were going very well and they were highly confident. Then the market rolls over and the stock goes down. Now, of course, when the stock goes down, your yield goes up. And of course, they've just raised their dividend, so your yield is much higher than it would have been before because of the combination of the lower stock price and the higher dividend. So you get a scenario where the market is treating everything the same, but certain companies perhaps may be better than other companies in that scenario. So we used an example, High Arctic Energy. I mean, it's a volatile stock, but in the middle of the sector decline in energy in November, they decided to raise their dividend. It was a pretty dramatic statement. Again, we won't talk about the company, but everybody knows what happened to the energy sector after November 13th. And here was a company that raised their dividend in the middle of all that, and their yield now is actually 5.3%. Other positive signs. We talked about the first ever dividend. You don't want it to be too high. But another thing to watch out for, and this is also coinciding with the first ever dividend, is keep an eye on how much money management is making. This is all public available data. If you go to www.cedar.com, you can see exactly how much the CEO, the chairman, and everybody, not everybody, but the top executives are making at a company. So say you've got a scenario where management is not paying themselves very much money, but they own a lot of stock. So say a company management team, the insiders own 30% of the company, and you look at the AIF and you decide that they're not really paying themselves industry rates. The only way they can make money now is either by getting their stock price up, selling the company, or paying themselves dividends. So if you have a company that has a scenario where they've just started a dividend and management owns a lot of stock, they may in fact be choosing to pay themselves with dividends instead of salary. Of course, dividends have better tax regimes than salary. And if you've been paying attention for the past 10 minutes, you'll know that dividends tend to move up stock prices. So as a company owner, just put yourself in their shoes. You have a couple of ways of paying yourself. You can pay yourself a giant salary, and that impacts your company's earnings. which may impact the valuation of the company and may ultimately result in you not having as much net worth as another scenario. And the second scenario is you pay a dividend. As a shareholder, you get part of that dividend. Your salary stays low, so your earnings at the company are not dramatically impacted by high compensation. Your earnings are higher, therefore your price of your stock is higher. Therefore, as an owner of the company, your net worth is just increased dramatically at the same time as getting yourself more money from the dividend. So it's a really, really good scenario for companies in the 50 million to 200 million range where insiders own a lot of stock. And when they start paying themselves a dividend, it's basically a sign saying, we're going to pay ourselves this way. You can join us along for that ride. You don't have to, but if you don't, we're just going to keep increasing our dividends and we'll keep them for ourselves. And often you get a scenario after a few years that they go private and decide that they don't even want to share the dividends with the public. So they go private at a premium and you get a little bonus on the way out as well. So that's one thing of prime importance as well. The other things you need to look for in terms of positive signs is consistency. The best stocks are those that increase their dividends on a regular basis. And so we've thrown out Fortis as the example. Fortis has increased their dividends 41 years straight. Will they increase their dividend in 2015? I have no idea, but I can tell you they've done it for the past 41 years. And so it would be a pretty big dramatic move if they decided not to increase their dividends. So investors love consistency for all sorts of reasons. But for an investor, if you own the stock, of course, consistency results in a better valuation. Companies that perform and are consistent and are stable just tend to get better valuations over time. And here we have Fortis, which is perhaps the most boring company I could throw at you. It's an electric utility in New York State and Atlantic Canada. So basically they generate and distribute electricity. And this boring stock pays you 3% dividend, and the stock went up 41% last year. So if that's boring, then I think most investors would be pretty happy with a portfolio of boring stocks. You also want slow and steady increases. A couple of more examples. Stantec, they actually started their very first dividend in 2012. Give me a minute on Stantec because they've been around for 53 years. They haven't been public for that long, but they've been in business for 53 years, and they've been profitable every year for more than half a century. So it took them 50 years before they decided to pay a dividend. They've increased the dividend twice since then, and that was quite a dramatic statement. Basically, we're going to be in business for half a century, figure out, how to run our business, make sure we can survive all sorts of ups and downs, and then we'll start to pay you a dividend. So these are sort of signs that you want to see in companies, and especially new companies, make sure they've got that consistency either in profits or consistency in dividends. Auto Canada, the stock hasn't done very much the past couple of months because of their exposure to energy, but they've had 15 consecutive quarters of dividend increases over the past 3 and a bit years. The stock's actually $36 today, so it's down from 50. But that dividend consistency has been very much in place for a fair bit of time now, not quite 41 years like Fortis, but so far so good. Other things to consider is a conservative payout ratio. So as mentioned, it's the dividends versus the cash flow, how much you're paying out versus how much you're bringing in. And we really think you should consider cash flow, not earnings. Earnings, we could have a whole other seminar on earnings and how earnings are manipulated. But basically, to put it into a nutshell, cash flow is just less. There's less ability to manipulate cash flow than there is to earnings. There's all sorts of earnings rules and earnings variability and flexibility in terms of what you can take as a charge to earnings. But in cash flow, it's really what's coming in and what's going out. So take a look at operating cash flow primarily. You may want to look at working capital adjustments because there's lots of companies that have inventory, receivables, accounts payables that kind of skew it a little bit. But if you take operating cash flow before working capital adjustments, it's the best start in terms of looking at cash flow. Then on the cash flow statement, if you go down a couple of lines, you'll get dividends paid. And all you have to do is compare one to the other. How much is being paid in dividends versus how much is coming in. So a couple of examples, Badger Daylighting, again, it's an energy services stock. Their payout ratio is 18%. Stock hasn't done a whole lot, but in terms of the dividend, they've got a pretty good cushion versus the energy industry. If the energy industry goes down, at least they've got a cushion on their cash flow versus their payout ratio. Auto Canada, the one we mentioned before, their payout ratio is 50% last quarter. Not a huge cushion, but obviously it's better than having a payout ratio at 90%, which a lot of companies have as well. So a few considerations here. You need to look at the cyclicality or the seasonality of a business. Cyclical companies in the the energy sector, the metal sector, anything that has up and down swings, you want to have a dividend payout ratio that is far less than a stable industrial or utility company. So if you're looking at a gold stock, just as an extreme example, who knows where gold is going to be over the next 10 years? You want a payout ratio that's got a very big cushion just in case gold goes the other way and goes down. Same with any sort of stock whose earnings are not their own destiny. So anybody that's got a commodity price, that they're price takers as opposed to price makers, you want to have a cushion for the downtimes on your dividend. And for all those in the oil and gas sector, certainly you've seen a lot of dividend cuts over the past 6 months and the subsequent stock price collapse. These are companies that have, their payout ratio is perhaps too high for a cyclical industry. But of course, I don't think anybody thought oil was going to go from $105 to $44 in a short period of time. But it is a cyclical industry, and it is a consideration when you're looking at dividend payout ratios. The other thing you have to look at, of course, is debt. A company with no debt has a far greater ability to keep paying its dividend much, much longer than a company that has a lot of debt. And so if you had a company with a payout ratio of 80% and no debt versus a company with a payout ratio of 80% and $1 billion in debt, they're not the same payout ratio. One is far riskier than the other, and companies will often dip into their cash to pay their dividend to maintain that payout, even when earnings and cash flow are not particularly strong. Much depends on how big the company is, of course, and what their plans are. But certainly, a better balance sheet is gets you a better valuation. It's safer, it's more secure, and for dividend investors, if you can get a low payout ratio and a good balance sheet, then you've got a great scenario. A couple of other things that we like to watch for at 5i is we really, really like to see how a company performs and how its dividends are treated in a really, really rough economic period. So the only thing good about 2008 and 2009 that it's recent history. So it's pretty easy for us to go back and see exactly what companies did when the financial world was just about ending. So two examples we've thrown out at you here. Home Capital, their dividend went from 5.5 cents per share to 8 cents per share in the middle of the financial crisis. Their earnings actually increased during this time, and they raised their dividend at the same time. The reason why that is a standout for us is because Home Capital is in the housing and mortgage business. They provide mortgages to, I don't want to call them subprime because that's got a bad connotation, but customers who can't get loans from the bank in the traditional manner. So here we have a mortgage company in the middle of the financial crisis that was caused by the real estate market and bad mortgages. We have a mortgage company that raises their dividends and increases their earnings in the middle of this crisis. So when the next crisis comes along, this is not a particular company that we're going to be worried about. This is one of the ones that we cover at 5i. But if they can raise their dividends in 2008, 2009, then I'm pretty sure they'll be able to survive the next crisis whenever that hits. TELUS, everybody should know TELUS. It's the telecommunication wireless company. They raised their dividend twice from 2007 to 2009. Again, the world was ending. Nobody really wanted to buy anything, yet TELUS had enough confidence to raise their dividends a couple of times during that period. So just to sum up that, you want to have a good balance sheet, a low payout ratio, earnings and profits and dividends during the bad times, preferably not a cyclical company. If you're cyclical, seasonal, you want to have a lower payout ratio, and you want consistency of that dividend increase to get the maximum bang for your buck in terms of capital gains on a stock. Talked about balance sheet strength a little bit. It is fairly obvious. If you've got no debt and a lot of cash, then you've got a longer ability to pay your dividend even when times are tough. WiLAN, I should update this. They actually just raised their dividend 2 times. last Friday by 5%, so that dividend is now about 6%, but they have 140 million cash, no debt. Again, it may not be the greatest company in the world, but not too worried about the dividend because of that cash position, the debt situation. Everett Technologies, they raised their dividend 12% late last year, and now yields 4%. Everett is actually in our model income portfolio, which has done pretty well. It's an example of 22 stocks that we've sort of highlighted for a portfolio scenario at 5i. So those are some good signs. Now on to the bad stuff. You do want to look at the payout ratio, and I generally like to use 60% as a average guideline. If you're over 60% in terms of dividend payout ratio, then it requires further work. You either have to look at what industry is the company in, what the seasonality is, what the cyclicality is, how much debt is there, what's the history of raising their dividends. It just requires much more work because 60% is kind of the line in the sand that we like to draw. So you want to have a lower payout ratio if possible, and if you have debt, then you even need an even lower payout ratio than before. So hopefully, if you take a look at a company that's highly cyclical, that has a lot of debt, and its payout ratio is 80%, please do not get excited by the yield of 9 or 10%, because that yield is 9 or 10% because that company may be far riskier than you think it is. And if you lose 50, 60, 70% of your stock price, which, trust me, has happened to a lot of investors over the past 2 years, that 9 or 10% yield pales in comparison to how much money you can lose on the stock by buying the wrong type of dividend stock. So make sure you don't get greedy. It's pretty standard investment policy, but a lot of people look at yield and say, wow, 11%, I want some of that. And they don't consider the ultimate problems that might happen if things don't go the way they want it to. A couple of more signs to look for. We talked about DRIPs a little bit, and dividend reinvestment plans are generally one of the greatest inventions in the history of investment. It allows you to buy more stock at a discount. It forces you to reinvest. It forces you not to sell because it's a big hassle to get your stock out of the plan and to calculate your taxes and everything like that. They're really, really good, but they're not always good, not always 100% of the time. Some companies, when things are rough, they will add a dividend reinvestment plan just to conserve cash. If you can convince half of your shareholders to take stock instead of cash, then suddenly you have far more available cash flow at the end of the day to do whatever it is you want to do with that cash. So many companies will do this as a bit of a last-ditch attempt. When things are tough, they'll add a DRIP plan and hope that everybody converts into stock, and suddenly they don't have to come up with that cash that I was talking about earlier in terms of having discipline to get the cash every 3 months. So it's a scenario where you have to take a look at the DRIP, how long it's been in place. Take a look at when the DRIP was actually added. That'll give you some good clues. If the DRIP was added during a really, really rough time, you may want to take a look at the cash flow and the cyclicality of that business much more closely than you would otherwise. Also, when we talked about this a little bit, is consider the DRIP dividends when calculating payout ratios. DRIPs for investors are completely optional. There's no obligation. So if you're in a DRIP plan and you're getting stock instead of cash, you can cancel that at any time. So if a company has a lot of shareholders in their DRIP plan and everyone decides to cancel, then they all of a sudden have to come up with more cash to pay those shareholders, pay the dividends in cash instead of stock. So you have to consider this when calculating your payout ratios, because even though they're not spending the cash today and putting out that cash as dividends, next quarter they might have to. So it's important consideration to take a look at when a company has a DRIP plan. And more companies are putting these plans in place, so it becomes a little bit more complicated. But just take a look at the actual amount of dividends that are being paid, whether it's cash or stock. Some more bad signs. This happens more often than you might think. Companies often will try and hide bad news with a dividend increase. So they'll come along and they'll report a quarter, and things may not be that great. Maybe growth is slowing down, maybe revenue is rolling over, but they'll increase their dividend anyway. They may be trying to protect their stock. They may be overconfident. They may just be having the blinders on and not really realizing what is happening in their industry. But they raise the dividend, in the face of declining fundamentals, and it's one thing to watch out for. So you've got a situation where the yield increases, but again, if the stock price goes down, then that extra dividend that you're getting is not really going to help you much. And poor old Horizon North Logistics, we use them as a dramatic example. They increased the dividend last February, but already at that time, they were starting to feel the impact of lower oil prices and lower projects that were being contracted out to them. And you've got a situation where the stock price has actually gone down. I'll give you a more recent quote as opposed to last week because the oil sector is moving so fast. It's now down 67% over the past 12 months, and its yield now is actually 14.75%. So again, watch out for companies. Just because they raise their dividend is not an automatic reason to buy it. You have to look beyond the fundamentals. It's a good sign, but you have to investigate to make sure that the fundamentals are there to support that dividend increase. So more bad signs. We can't stress this one enough. Even though you've heard it before, you'd be absolutely shocked at how many investors make this mistake again, and again. A high yield almost always signifies very high risk. Really, the only exception is when everything goes down, when the whole market collapses for whatever reason and everything declines in price and yields go up across the board. Of course, in that scenario, not every company is going to be in trouble, but every yield has gone up. So I like to use the bank example in 2008 when some of the big banks in Canada were trading at 12, 13, 14% dividend yields because the world was ending. The banks in particular may have had some issues, but the whole market had declined, and so it's quite an unusual scenario, which doesn't happen that often, thank goodness. But you want to get a situation where you do not want a high dividend yield just because it's a high dividend yield. You have to do some research, and 9 times out of 10, the high yield will tell you to stay away from the stock. Again, if you lose 70% on a company, your 20% yield is not going to matter much. You're still going to be significantly behind the 8 ball in terms of your portfolio. So watch out for high yields. A couple of examples there. Data Group yielded 20% in 2013. Doesn't yield anything right now. It just stopped their dividend completely, and the stock took a very, very big hit. Twin Butte is an energy company. They've already cut their dividend, actually, so that dividend has been adjusted a little bit, but they had some operational concerns, and a lot of people were attracted to the high yield. It even yields 16% now to reflect some of the risks they still have. The one that really kind of confuses us on a daily basis is Western One Energy. Their dividend today, again, I'll give you a live price, well, the market's closed, but a closing price. Their dividend yield right now is 23.5%. They absolutely have so far refused to cut their dividends, even though everybody else in the industry is sort of thrown in the towel. But their stock is down 62% in the past year. So their 23% dividend is really not going to help you much when you've lost 63% in 52 weeks. Some more bad signs. It's unfortunately I have more bad signs than good signs, but if you can avoid the problems, then your portfolio is going to be in much better shape. First dividend cut is almost never the only dividend cut. And here's where you really have to be cynical. In my investment career, I had so many management teams present to us, day in, day out, 300 or 400 meetings a year for a very, very long time. And we just became very, very, very cynical because a lot of management teams would just out and out lie to you. And a lot of management teams just wouldn't even really understand the situation in terms of their confidence was far greater than the reality. And so they would be, again, the blinders would be on and they would be telling a sales pitch as opposed to a reality story. And time and time again, companies would basically say, don't worry, everything's going to be fine. And it wasn't. So when a company cuts a dividend, it is such a dramatic move for a board of directors to cut a dividend. Trust me, I've been on the board of directors of at least one public company, and the dividend is taken very seriously. A dividend cut, the board of directors would fret over it for weeks and weeks at a time before cutting it. And generally, they don't cut it until they have to. But unfortunately, when it's time, when they have to cut a dividend, it means that things have really quite deteriorated badly. And often the first cut is not the only cuts. So poor old Atlantic Power, they cut their first dividend for the first time in March 2013. And then a year and a bit later, they had to cut it again. and the stock has not done that well. It's doing a bit better this year. It had a little bit of a bounce. There's some takeover rumors on it, but the dividend cut has hurt a lot of investors. This used to be a stock above $10, and now it's in the $3 range. So watch out for the first cut. When a company cuts a dividend, management will always tell you that will get their dividend to a sustainable point, planning for the future, it's prudent capital management, et cetera, et cetera, et cetera. Basically, I'm telling you not to believe any of it. Watch out for the first cut, because it usually means something really, really bad is happening to the company. So those are sort of the negative viewpoints. So hopefully we've given you a couple of good points and a couple of things to avoid. And if you take away anything at all, just focus on companies that are growing their dividends, companies with no debt, and companies that have high management ownership and don't dilute their stock. Sort of, if we were doing a non-dividend seminar, a lot of those would be the same. You want companies with good management, high ownership interest, not diluting their shareholders, good growth, good cash flow, good revenue, good product, and then when they add in a dividend, you want it to start low and grow consistently over time, and that'll give you the best stock you can get over time if it has all of those attributes. So when you're looking at dividend stocks or stocks in general, you just want to avoid some of the mistakes that a lot of investors make. You want to avoid reduced fees as much as possible. Every time you make a switch from one company to another, you have to consider the tax implications and the trading costs. Trading costs are dramatically lower these days, which is great, but you want to keep it simple as well. You want to, any security product that has got all sorts of bells and whistles, derivatives, guarantees, reset provisions, things like that, all of those add additional costs to any sort of product. So we're not big on a lot of closed-end funds. They basically are designed to sell, and investors get, they start off with 93 cents on the dollar because 7 cents on the dollar goes to someone else in terms of fees, lawyer fees, banker fees, and broker commissions. You have to watch conflicts of interest, of course. When you have an advisor telling you something, you have to make sure that they're not benefiting from that. Most of this is common sense, but really is we need to highlight it always, because there's so many people that want a piece of your money, but of course you're the only one that's going to care about your money the most. So make sure you, one of the biggest things is taxes. If you can avoid taxes or defer taxes, your whole investment career will be much better off because of it. So if you want to skip all those fees and don't make those fund managers any richer than they are, you can set up your own dividend mutual fund portfolio very, very easy. And I think in Canada, it's almost a no-brainer, because if you look at the average dividend fund in Canada, I'm just pulling numbers off the top of my head, but I can bet they're very, very close. Probably 85% of the securities in the average Canadian mutual fund are the same. So in other words, 85% of our portfolio, if you looked at 10 different dividend funds, would be exactly the same. They would all own BCE, they would all own TELUS, they'd all own Rogers, they'd all own CN, Methanex, and all these things that are nice dividend companies. And then they would just sort of play around with the other 15%. So knowing that, you can set up your own portfolio and save yourself 2.5% or 2% management fees, and you'll be much better than the professionals who are doing it all day long just by that fee differential. So what you need to do is diversify your mini portfolio by sector. There's 10 TSX sectors. You might want to have all of them. Some people skip healthcare because it's pretty volatile, and Canada doesn't have that many great healthcare companies. You want to diversify by geography. There's plenty of companies that have lots of business outside of Canada, so you could diversify by buying the company with U.S. revenue, U.S. business. Diversify by market cap. A lot of people forget this. They just buy large caps, and they think that buying a slow, steady company is the best thing to do. There's nothing wrong with a slow, steady, large cap company, but it won't get you that dividend growth that a smaller company will get you, and it certainly won't get you that earnings growth that a smaller company will get you. But we're not advocating to go all in on small caps. We're just advocating diversification. You don't want your portfolio to be top heavy in large caps, and you certainly don't want it to be bottom heavy in small caps. Just have a little bit of everything. You want to diversify by style. There's plenty of companies out there that would be considered value stocks. Stocks that are cheap, perhaps boring, but they have good cash flow. Maybe their earnings are not dramatically exciting, they're not sexy, but the valuation reflects that. So they're very, very cheap stocks. Often they get taken over. Sometimes you have to wait 5 years for them to get taken over, but if you get a nice premium, then it works out pretty well. And we can use the example of Glentel, which for the past 2 years was a bit of a basket case. The stock did absolutely nothing, and then it got taken over at 105% premium. So all those value investors who bought it at 10 or 11 times earnings suddenly found themselves with a quick double on the takeover. So diversify into value stocks, but also diversify into growth stocks. Growth stocks tend to be higher priced, higher valued, I should say, not necessarily higher priced, but valued higher because of that rapid growth. Use caution with high dividend payers. Again, if you have a choice between a high dividend and a low dividend that's going to grow, always choose the low dividend that's going to grow. And then you can diversify your securities by payment cycles. Companies tend to pay every 3 months, but you can have a few companies that pay in the March, June, September, December cycle, and a couple of other companies that pay in January, April, August. And you can actually set up your portfolio to make sure you get income every single month from your little investment portfolio. And you sit back like those lazy students that I had to teach and collect your dividends. Ideally, you'd have 15 to 20 stocks, but it's a relatively simple process, and you have to look at it from a portfolio approach. Of course, they're not all going to work out well, but over time, I think you'll find that even the reduction in fees will set you up pretty well. You'll be the master of your own portfolio. You won't be buying a Porsche for some guy on Bay Street, and you'll probably do better because all the Bay Street boys are watching the index. And I should just go on a sidebar there. I think the index, a lot of people watch TSX index, but if you notice over the past year, the TSX index had 26% energy weighting. And obviously with a big decline in energy, the index got hit. And if you're following the index, you got hit as well. And if your mutual fund was following the index, you got hit as well. So I don't know if anybody needs 26% energy. So you may want to set up your portfolio to be more diversified, and there's no reason you need to follow a TSX index. And if I take you back a decade or so, at one point, Nortel was 46% of the TSX index. If that doesn't tell you, maybe you shouldn't follow the index. I'm not too sure what I can tell you to not follow the index. So just make sure your portfolio is diversified. Don't worry about how it relates to something else. Make sure it relates to what you need from your personal situation, your personal objectives. If you don't want to go your own route in setting up a dividend fund for yourself, here are a couple of examples. For examples, Vanguard Dividend Appreciation, iShares Canadian Dividend Aristocrats. These are companies that have raised their dividends for 5 consecutive years. It's a nice little index to follow because it, again, it highlights the fact that dividend growth is far more important than high dividends. VGG is the U.S. version of the one above, and XHD is the high dividend in particular. So at this point on our website, we have a chart that indicates that high dividends are still not as good as growing dividends. So growing dividends beat the TSX, they beat non-dividend paying companies, and they beat high dividends. They beat sort of all categories. Dividend growth sort of beats all categories. So that's sort of it in a nutshell. We're going to open up for questions. We actually do have a 5i 1-month offer that Questrade is going to send out an email out regarding that. And a lot of this information is available on our websites as well. If you missed some of it, we can walk you through some other stuff as well there. So I'm opening it up for questions, Derek.
Okay, thank you, Peter. That was an amazing presentation. We'll now open up the floor to any questions, and we'll try to answer as many as possible. But if we can't get to your question today, we'll have a representative from Questrade respond shortly. So our first question is from another Peter, and the question is, how and where do you find the best companies for dividend investment? Are there any websites to do the screening?
That's actually a very tough question for us because we use Bloomberg exclusively to do our screening. The TMX Money website has got some good information. Google Finance, CNBC has got some good U.S. information. The one thing we've basically had a very, very hard time duplicating in the webosphere, other than Bloomberg, is dividend increases. This information used to be published in newspapers, and it was also published in the TSX Review, which was a publication that you could subscribe to. But now it's this almost non-existent. The only thing I could suggest for dividend increases would be a newswire like Canada Newswire. Unfortunately, you kind of have to go through 100 press releases each day to see who raised their dividend. But it's often worth its while to find those stocks. Otherwise, you know, there's lots of screening services that you can pay for, but I don't really want to compare other products because I'm really just familiar with Bloomberg there.
Okay, and we have a question from Elaine, and she is asking, in a rising interest rate environment, doesn't the share price go down since you can get the same return for a safer investment?
Yes and no. It is a good point because as competing investments increase in yield, then obviously stocks which carry some risk become less attractive to investors. I think the difference is, though, is how fast interest rates go up. So if interest rates go up slowly and the economy continues to rise, then companies do have the ability to increase their dividends even in interest rate increases. So growth companies tend to do better in that environment because they have the pricing power and they have the ability to keep raising dividends. The sectors that tend to get hit with rising prices are slow, stable, dividend-paying companies that are less likely to increase their dividends. So some of the utilities, some of the pipelines, they can be quite vulnerable if interest rates spike up. Obviously, if GICs were paying 5%, not too many people would want to take a risk in an equity paying 5%. But again, it's really a question of how fast they rise and the ultimate level that they hit before stabilizing. So right now, I think the scenario is, you know, probably going to be slow and steady, and I think the economy will probably be able to handle that. But it is a consideration. You don't want all of your investments in utilities, which might get hit the most when rates start to rise.
Okay, and we have a question from Dennis and a handful of other participants. And the question is, where can we look up management salaries that are paid in dividends?
Okay, so if you go to cedar.com, so www.sedar.com, that's the public site that lists every single public company has to file their documents there, and it's quite an easily searchable name. You go by alphabet, so if your company name starts with A, you just click on A, and then you find all the documents of that company. And what you're looking for, the two documents that really I think are the most important, are the Management Information Circular and the Annual Information Form. So the Information Circular and the AIF, I like to call it for short. In those documents, you will get both a very, very good history of the company, how they've performed, what they've done in the past, what they plan for the future. It'll outline all the risks, but in the Management Information Circular, they will tell you exactly what the top executives get paid and what that percentage of compensation is in terms of actual salary versus dividends. And so that's the key document to try and spot those companies that are paying dividends where the management wants dividends instead of salary.
Thank you, Peter. And we have another question from Barry, and his question is about real estate investment trusts, REITs. And the question is, your consideration of payout ratios is important, but practically all REITs are paying out a substantial cash flow to their shareholders. What's your criteria for purchasing a REIT?
Sure, it's a good point. I was going to talk about REITs in that slide. REITs are a separate corporate structure where they have to pay out the majority of their cash flow. So it's basically cash flow that's flowed through to their investors. And they're also taxed differently than regular dividends. So all the payout ratios for REITs tend to be in the 80% plus range, and some are even 99, 98%. So it does have to be considered separately in terms of looking at other companies in terms of their dividend payout ratios. But what you want to look for is a couple of points. The ratio is important. The other thing that's quite important is the debt to value ratio. So all these companies will report how much debt they have versus the value of their real estate portfolio. You want to see that below 50% generally. Again, it's all about how much cushion you have if there's a real estate slowdown or a real estate collapse even. Some of the real estate investment trusts are even 65% debt to value. And again, like anything, debt is fine if things work out, but if it doesn't work out, then you don't want too much debt versus value. So that's your, instead of a dividend payout ratio, that's your other cushion to look at in the REIT sector. And then there's two other things that are quite important. One is the occupancy level. Right now, they're very, very high. They tend to be 95% plus, which means there's only a small portion of the real estate is unoccupied. And you also want to look at the vacant or the lease rollover rate. So, and this is all listed publicly. They'll tell you sort of how much of their leases are coming due, and that's your that's a risk metric. If there's a competitive market and you've got 20% of your leases coming due next year, then you may lose some of those customers, or you may have to sign them at lower payments than you did before. And so that's very important. You want that lease rate schedule to be well diversified and over a few years, certainly to spread out your risk over time. But the debt ratio is quite important, and but you also want them growing as well. You need to see rent increases, and you need to see good acquisitions that are accretive to cash flow, and you need to see that vacancy ratio stay high.
Thank you, Peter. And that's all the time we have for today. We'll have a representative answer your question via email if we didn't get to it. And I want to thank Peter for joining us today and delivering this fantastic webinar.
Thanks,
it was truly a pleasure to have you and your organization come in and deliver this.
Thank you.
Thank you.